Welcome back to Money Made Simple. What if one of the biggest assumptions in retirement planning is simply wrong? Most retirement calculators and financial plans assume your spending will rise every year with inflation, basically a straight line going up forever. But what if that's not how retirees actually spend? JP Morgan analyzed real-world spending data from millions of households and found a very different retirement spending pattern along with three major insights that could change how much you think you need to save, how you plan withdrawals, and whether you're oversaving at the cost of enjoying life today. Let's break it down. 1. The lifetime spending curve is real. JP Morgan found that spending follows a predictable pattern over a lifetime. Spending tends to rise from your 20s into your 40s, peaks in your late 40s and early 50s, and then gradually declines in retirement. And yes, healthcare costs often rise later in life, but many other categories tend to fall with age, like transportation, travel, dining out, and entertainment. And for many retirees, those decreases can outweigh the increases. 2. Inflation models often overestimate retirement spending. This is a big one. Traditional models assume your spending increases every year by something like 2 to 3%, because that's roughly what long-term inflation has averaged. But JP Morgan's real-world data suggests retiree spending doesn't rise that quickly in practice, and that difference compounds over time. When you compare a fixed inflation increase model to a more realistic spending path, you can end up with a huge gap in what a retiree is projected to need versus what they typically spend. That matters because overestimating retirement spending can lead to saving more than necessary, delaying retirement longer than needed, and being overly restrictive with spending, especially early in retirement. 3. Retirement spending often surges around retirement then slows down. JP Morgan found a critical spending window around retirement, the 2 years before retirement and the first few years after. During this period, many people spend noticeably more, sometimes significantly more often due to travel and leisure, relocating, home projects and renovations, big life transition expenses. But after that initial surge, spending often settles down and trends lower as retirees age. The takeaway: it is smart to plan for higher spending early in retirement, but you also need to make sure your withdrawals stay sustainable, because those early years of retirement are where one major risk becomes a huge deal. Sequence of returns risk: the first years matter most. If markets do well early in retirement, your portfolio can grow while you're withdrawing, which makes the plan much easier. But if markets drop early, you may be forced to sell investments when they rebound, locking in losses and leaving less money to recover later. That's sequence of returns risk. True retirees could earn the same average return over time, but the one who experiences losses early can run out of money much sooner, even with the same withdrawal rate. So when you combine a spending surge around retirement with a bad early market period, that's when retirement plans can get stressed. That's why flexible withdrawal strategies and having a plan for down markets matters. Spending isn't a straight line. Most retirees don't spend perfectly. One of the most important conclusions from the study is this: most retirees do not spend in a stable, predictable pattern that rises neatly with inflation every year. Spending changes, life changes. Some retirees steadily reduce spending. Some increase spending. Some have spikes for big events. And some have ongoing volatility. That challenges the idea that retirement spending is a simple formula. The 3 phases of retirement spending: a more realistic view is that retirement spending often moves in phases. The go-go years, early retirement, when retirees are most active, travel, experiences, home projects. The slow-go years, activity slows down. Spending becomes more routine maintenance, hobbies, family time. The no-go years, Later years where spending often declines overall even if healthcare rises because many other categories drop sharply. The big idea is simple. Retirement spending tends to start higher and then taper over time. What this means for you, this is why many retirees end up with more money later than they expected. They planned for spending to rise forever, but real life didn't work that way. And this also explains why some people feel like they're sacrificing too much now. They might be saving based on models that overestimate what retirement will cost. Now, I am not saying you shouldn't plan carefully or that you shouldn't have a cushion. Peace of mind matters. But it is worth asking. Are you planning based on a rigid model? Or based on how people actually spend? So let me ask you, does this change how you think about retirement spending? Would you be willing to use a more flexible withdrawal plan instead of a fixed inflation-based approach? Drop your thoughts in the comments. If this was helpful, hit like, subscribe to Money Made Simple, and share this with someone planning retirement. See you in the next one.